How's it going, everybody? Welcome to the channel. Welcome back to the channel. What is up? Anyways, in the stock market, there's a few different ways you can buy stocks, but there's one surefire way that I believe is top notch. One of the best ways to buy stocks. It limits your risk on the downside and increases your gain on the upside. So, it's a win-win situation. Minimize losses while maximizing gains. After all, that's the name of the game, right? You gotta maintain capital and gain it, not lose it, or else you're just gonna dig yourself a hole. So what is that strategy? Well, I'm about to get into that in a second. I'm not gonna do a whole big spiel, talk for a minute. The only thing I wanna say is, remember to always like this video, hit the subscribe button, and turn on that bell notification to always stay notified in all the latest and greatest videos that I post. Alright, without further ado, what is the strategy? Well, quite simply, it's this. You just take a sip. Yep. You don't drink the whole damn bottle. You just take a sip. All right. And that is exactly what this strategy is. It's the sip strategy. What does that mean? Well, let me write it on the board and then we'll talk about it. All right. So what does SIP stand for? It stands for small initial position. Yes. Small initial position. What does that mean? A small initial position means exactly what a sip means, is you just take a sip. You don't, go all in, you don't drink it all, you don't do whatever. You just kind of dip your toes in the water. Now, let me give you an example. Say you have, we'll go with $10,000 to invest, all right? Decent chunk of money. It could be 1,000, could be 100,000, I don't know. But whatever it is, say it's 10,000 and you want to buy a stock. Whatever that stock is. Say the stock is stock A, B, Z. Yeah, ABZ. Kind of sounds cool. Anyways, so you buy stock ABZ. Alright, so you want to buy $10,000 of ABZ. Now, instead of buying, let's say the stock is $100. Alright? Nice, even numbers. Not confuse anybody. Super easy. So $10,000 is what you have to invest. You're going to buy stock ABZ, and it's currently at $100. Now let's go over something. If you take your $10,000 and you buy ABZ, let's forget about trading commissions or anything like that for a second. Maybe you have Robinhood, who knows? And you do this, how many shares can you get? Well, 100 divided by 10,000 just so happens to be 100. So at this current rate, this would equal 100 shares. If you just do this strategy, you just buy it. All right, so pretty simple, right? Like if it goes down $1, you're gonna lose $100, all right? And if it goes up $1, you're gonna make up $100, vice versa. So this is not the strategy I would suggest. This is like a basic. What I would suggest is you do this. So you take your $10,000, let's put a dollar sign, and then you divide it by 4, okay? So when you divide it by 4, that's gonna break it into quarters, meaning this is now gonna be $2,500 to invest 4 times. So you take stock ABZ and you decide to buy it at $100 and you buy your 2,500 shares, all right? So, or you buy your $2,500 worth. So you buy that at $2,500, which would equal 25 shares. Cool. Now let's imagine the stock's gonna go down, because in all my years of investing, I don't know why, it just so happens that most of the time when I'm buying a stock and it's on the way down, it tends to go down even further. Now let's imagine it goes down to $90, all right? Now obviously, 2 things are happening right now. One, you're losing money. You've lost money, plain and simple. The second thing is, well, you still have $7,500 left to invest. So you're going to buy more because, well, you have $10,000 and you want to, buy $10,000 worth of this stock. So actually something pretty magical happens. So you're going to invest your same $2,500. But something magical happens this time. And that is going to actually equal 27.77 shares. Pretty cool. You actually got an extra 2.77 shares, but you spent the same amount of money. Right there, that's a really good thing. And you're now averaging down. An average cost basis would be around, right here, it would be around $95. So that would be pretty cool. So now, if it goes up to 100, you're actually making money. Sweet, right? Where over here, if it went down to $90, you'd be down $1,000. As of this point, it went down to $90, you're down $250. Still sucks, but it's better than being down $1,000. And not to mention, you're making money $5 earlier with this one. Now say it goes down again, and it goes down to $80, all right? Yeah, you picked a real loser here. It's down 20%. You know what? That's fine. That's actually a good thing, because you still have money left to invest. So you take your next $2,500, and you can now buy 31.25 shares. Awesome, even better. Now you're getting an extra 6.25 shares versus your just 25. And now your average cost basis is even lower. It's more like around $90. So after all this, let's say, you know what, it actually goes back up. And it goes back up from 80 and it goes, you know, back to like $90, all right? It goes to $90 a share. Well, you know what, you still got your last 2,500. So you're gonna go ahead and you're gonna spend your last 2,500, equaling 27.77 shares. Cool, not bad. So after all is said and done, what happened? Like, this is a lot. It might be confusing people. Hopefully not, but let's walk through it. So scenario one, you have your $10,000. You bought ABZ at $100, meaning you have 100 shares. Simple. Now, with the small initial position strategy, you took that $10,000 and you broke it up into 4. So you're going to buy the stock a total of 4 times, meaning you're going to spend $2,500 each time you buy it. So the stock was at $100 like it was there. You decide to buy $2,500 worth. You got 25 shares. Cool. Simple. It then dropped down $10. Sucks. You're losing money. You lost $250. But you still have money left over. So you took another $2,500, bought it at $90, meaning you got 27.77 shares. Awesome. Then the stock went down even further. Yikes, you're obviously losing money. It's down 20%. That sucks. But because you only bought $5,000 worth and you still have another $5,000, you decided to buy another $2,500 worth. So now you can buy 31.25 shares. Sweet. Now it goes back up to 90. It happens. It's not going to go down forever. If you pick a decent company, it should eventually go back up. So you bought your last 2,500. You then again get 27.77 shares. Now what does all this mean? Well, it means your cost basis is definitely a lot lower. Your cost basis, so your average cost, as of right now, if anyone wants to take a guess, it's just a touch under $90. It's 89.45 is the exact number. All right. So you're at $89.45 is your current cost basis. How many shares do you own? Because obviously this is a bit of a cluster. Well, as of right now, the current number of shares that you have are 111.79 shares. Yes, you have 111.79 shares, which means should the stock hit $100 again, you'd already be up 11%, making that worth over $1,100. Sweet. Absolutely amazing. All right. So that is why you should do the small initial position strategy, because over here, if this went back to 100, you would only break even. Now, should this hit 100, you'd already be up 11%, which would be over $1,000, over $1,100. All right. And that's if it's at the exact same price. You spent the exact same money, but you got way more. This is the exact reason you want to do this strategy. You minimize your risk on the downside. The stock went down. See, as you can see here, it went down to 90. At 90, you're only down $250. That's it. And if the stock were to go to 80, over here, you'd be down $2,000. $2,000. Where over here, you're obviously down substantially less. At 80, you're down about $500, and then you bought some more. All right. So technically, you're not down any further. And at 90, you're already breaking even per se. So when this hit 90 and your average cost basis is $89.45, at $90 you're actually slightly profitable. Where over here you'd be down over $1,000. That's the difference. So obviously this is kind of like a good case scenario where the stock went down, you were able to buy more. But I'm telling you, it's actually pretty common for that to happen. I can't tell you how many times I decided to buy a stock and then it went down after. My first couple of years I did not really do this strategy. However, since I've done it, I've realized I've made a lot more money and I've lost less money, unrealized, not actually technically lost in a sense, but unrealized losses were lower because I was buying lower. So then by the time it went back up, I was already making money. Pretty phenomenal. So not only was I getting more, I was making more. So you get more shares and you can make more money. Not to mention if these shares pay dividends, well, you have like 11 extra shares now that pay you dividends. That's money straight in your pocket. All right. So that's the reason you want to do this. It's super cool. It's super handy. It's honestly one of the best strategies to use when buying. Let me know down in the comment section. Do you use this? Do you not use this? Do you think it's a stupid strategy, a cool strategy? What strategies do you use? There's a few different strategies that people use, but if you just want to buy stocks, plain and simple, I think this is one of the best strategies you should implement in trading. Try it out. Doesn't really cost anything. Maybe a little bit of fees if you have fees with your bank. But again, it shouldn't be too much money, maybe $5 to $10 a trade. So maybe this will cost a little bit more money. However, there's way more potential gain to the upside, even if this costs you an extra 20, 30, 40 bucks or whatever. So anyways, thank you for watching, and until next time, see you later and have an absolutely amazing, beautiful, life-changing, one-of-a-kind day, and I'll see you next time.